Well, welcome back to Finance Uncut. On today's episode, are we about to see an 80% stock market crash while gold goes to 10,000 and silver to $300?
So, what do you see? You talked about a 39-year, essentially debt super cycle coming to an end. What's on the other side of it?
I want to correct that because it's a 39-year bull market in the stock market. I am not in the camp that says this is the top of the debt super cycle. Believe it or not, because of the bust, and we haven't talked much about it this time, but because I expect an 80% bear market or 70-80% bear market, and what I describe as a bust that will be the biggest downturn in the post-World War II era, bigger than 2008-9. And I think that begins late this year and carries through next year. Because of that, there will be, if we think what we've seen so far in terms of the government relief is big, just wait. Because what will come on the other side of in response to the bust will be money like we've never seen. So we've grown the Fed's balance sheet to $7.5 trillion. I believe in response to the bust, it will grow to over 20 trillion because that's what it'll take to keep the system from imploding. And you'll have similar expansion in treasury debt, in government debt. And again, I'm talking US, but it's around the world, similar proportional type stuff. So what that means is you're going to have a involuntary debt liquidation cycle in the bust, meaning a lot of bankruptcies in the oil patch and in junk bonds, et cetera. But because of the sovereign debt response, you're going to have another big leg up in debt. So by the end of this decade, I think you may go from 250 trillion at the peak, this cycle, to something closer to 350 or 400 trillion at the end of the decade. Most of it soon after the bust. Most of it in the couple of years following the bust, trying to get us out of the hole. So I think the debt peak is still one more cycle out or one more recovery out. And then I think you get the true crescendo crash where it's the end of a super cycle. But so the stock market makes its peak now. You won't see highs beyond this cycle's highs, but the debt peak will be another 7 or 8 years out.
So essentially, David is seeing a 70 to 80% stock market crash. Now, look, he could be right. Harry Dent's certainly in his corner. I don't think it's going to be that big. It certainly can. Certainly can. The probability is there, or the possibility, sorry, is there. I don't think I'm in that camp that it's going to crash 80% though. Look, during the 1929 bust, from peak to trough, the market did crash over 80%. But central banks back then didn't do a heck of a lot. At the moment, we are seeing almost MMT. We look. You've got the Japanese, the Bank of Japan, now buying ETFs in their stock market. We've seen the Fed set up all these special purpose vehicles, using BlackRock to buy corporate bonds, which, according to the Federal Reserve Act, is against the law. But who's challenging them? So I just see that central banks will just do whatever they can, and governments will support it. And if laws need to be changed, governments will change laws. I definitely think there is a crash coming. And I've done videos in the past where I say that we probably might be looking or headed to a 1973-74 type situation where we have a 50% crash in in nominal terms, in the stock market while inflation is raging at 12% or so. So I'm definitely on the inflation camp. So, you know, are we in a bubble? You know, the symmetries are there. I certainly think we're in an everything bubble. It's not a stock market bubble. I think the biggest bubble that on earth at the moment is the bond market. One thing I think to keep an eye on is margin debt. Margin debt is absolutely skyrocketing at the moment. Margin debt and options from retail buyers. So retail traders have jumped into the options market like I've never seen before. But also margin debt. So you can see here the margin debt growth since that pullback late last year is almost gone vertical. And when we've had other large spikes in margin debt, what's been the response? Well, you can see it right here. So going back to the dot-com bubble, margin debt spike. What happens? About 6 months later, bang. The GFC margin debt, I think it was about 4.5 months later, bang. Now look at us now. Now this is that real margin debt growth and the S&P 500 growth. So yeah, US debt, margin debt has absolutely exploded. And I think this is going to come back and bite us in the backside. Many people are warning. There is another reason that I think could pop the stock market in particular, and actually the whole asset bubble. But I'll save that for the next video. So yeah, here you can see margin debt increase. The S&P held up for 6 months back in the dot-com bubble and then pop. And then GFC, you can see in that light blue, you can see that margin debt growth once again skyrocketed, and 4.5 months later, pop. Look now. So we've got this margin debt increasing. How long can the S&P 500 hold up for? So I definitely think that we are in for a market correction. It's just timing. It's so much liquidity being pumped into the stock market or into asset prices in general. When you look at graphs, data of liquidity and debt and asset prices, it has a beautiful correlation there. So I personally think we are sometime this year. So I agree with David that we are going to see a market correction. Second quarter, third quarter, fourth quarter, certainly by the fourth quarter, I think we're going to see a market correction. However, as soon as the market starts doing a tantrum, do central banks just come in and just turn the taps, just open them up and just flood the system with even more liquidity and pump an even bigger bubble? Maybe. We'll come to that in a sec. The other interesting thing is insiders. So this is executives running companies are selling at the highest level in history. So insiders running these companies are bearish. They're not bullish. So here we go. So this is from the Fed Governor, Brainard. A rising appetite for risk across a variety of asset markets is stretching valuations and creating vulnerabilities in the US financial system, the Federal Reserve said in its semi-annual financial stability report. Vulnerabilities associated with elevated risk appetite are rising, Fed Governor Brainard, the head of the board's Financial Stability Committee, said in a statement accompanying the report released Thursday. The combination of stretched valuations with very high levels of corporate indebtedness bear watching because of the potential to amplify the effects of the repricing event. Absolutely. So with the margin debt, corporate debt, just about the everything debt, absolutely when things go the other way, it goes very fast. When that debt implodes, it goes very fast. In this environment, prices may be vulnerable to significant declines should risk appetite fall, the Fed report noted. So I know we laugh at the Fed, and I know we mock the Fed. I hate the Fed. I proudly wear my "End the Fed" hat around all the time. However, more and more central bankers, not just the Fed, but central bankers around the world, are now starting to warn about asset prices and debt levels, and saying that there could be significant falls. Some Fed officials are saying, "Well, hey, we're not gonna, save it. So Wall Street, if you want to be silly and go and take all these risks, you're on your own." So perhaps if there is a crash and the central banks just allow it to happen, they stand back and they say, "Well, you made silly decisions." They can say, "Well, we told you so." They can say, "We warned you, we warned you." Now, it's not just them warning, but legendary investor Jeremy Grantham, who called the dot-com bubble and the 2008 financial crisis, is warning of the biggest loss of perceived value from assets that we have ever seen. Once again, he's probably with David as well, in saying we're going to see a massive crash. And now, look, he has been criticized because he hasn't participated in this run up in stock prices in particular. But he's warning. And it's not just him warning as well. Stan Druckenmiller is riding the raging mania in stocks, but expects to sell before the year's end. Now, Stan just did an interview with CNBC where he said basically monkeys can profit in this everything bubble, in this raging mania. You don't have to be an investment guru to make profits in this market. But he's warning that it is overcooked, that it is done, and he's saying that he expects to sell before the end of the year. So basically, he's seeing a market downturn before the end of the year. How much doesn't say, when he doesn't know, and that's the truth. Is none of us know. None of us know. So if the stock market's going to crash and do so terrible, then where do we invest? What do we do with our money? Let's go back to David and see what he has to say about especially gold and silver.
How do you think that this affects commodities, right? You talk about gold, you talk about silver, you talk about commodities, you talked about oil. So what's the impact on all this?
Yeah, so that response to the bust, we've got inflation this year, and I think it's going to get bigger before it gets smaller. So we'll have more inflation building up through the summer. I'm calling for oil to get $75 a barrel, or a little more, probably by sometime this summer. So we're at 60 now. So maybe another 65 now, maybe another $10 up. I'm not sure it's straight from here. I actually think we'll pull back in oil, maybe get to the low 50s and then make the run to 75. But either way, I think oil has higher highs from here. Copper is going to go higher. Gold's going to go higher here. So you're going to have a mini inflation boom that we're already starting, obviously, between now and fourth quarter. But then the bust, I call it deflationary bust, because I think it's going to be such a bad downturn that it will take this mini inflation boom and turn it all the way into negative. So we'll have negative inflation next year. And then from there, because of the response to the bust, you get a big commodity cycle. And you'll have a big inflation cycle beginning in probably 2023, starts slow. And then by the time you're in the late 2020s, you'll have gold at 10,000, you'll have silver at 300 plus, you'll have oil at 300 plus, you'll have copper, 5 times its current price, you'll have natural gas through the roof, you'll have gasoline prices in the double digits. So we'll have a big inflation boom like we haven't had since 1970s, and how that all plays out for the consumer, it's hard to believe the consumer will be on its feet if you have all of that. But there'll be wages going up and things, but with a lag. So I'm not sure how all that plays out, but I think that's what we're set up for. As you've spent 40 years disinflating the economy, because of the bust, you go, the party always goes too far. Because of the bust, it'll go into negative territory next year, negative inflation. And then because of the response to that, you get this massive, less than 1 decade long inflation boom. And then that becomes the real problem out 6, 7, 8 years.
So David thinks by the end of this decade, gold's going to be $10,000 an ounce and silver's going to be around $300 an ounce, due to governments and central banks just pumping currency, into the economy, which is going to create this raging inflation after the bust, though, he says. So, I don't know. I don't know how this is going to play out. But one thing's for certain: when you go back and look at stocks during inflationary periods, they actually don't perform very well at all. So stocks are not an inflationary hedge. Even in the 1940s, when we had 3 spikes of inflation, really high inflation, one of those spikes of inflation in the 40s hit almost 20%. And you can see in the 40s there that the market actually went down for half the decade. It wasn't until towards right near the end of the decade that it broke its, kind of early 40s high. So stocks definitely don't provide an inflation hedge. But that's not to say, for me anyway, that I'm going to completely get out of the stock market. Because if you go back, have a look at these times, there were stocks that did extremely well. You go back to the 1929 or the early 30s crash there. There are some stocks that did really well, some certain sectors. And I've shared before that I am very bullish. Commodities, I'm very bullish. All the metals, gold and silver, but other metals as well, copper, nickel, zinc, all of that. Obviously, bullish soft commodities as well. But also biotech. I've heavily invested in biotech in the past and done extremely well. And currently I'm invested in the biotech sector as well. That's a sector that I like. And these sectors really are kind of separated from the overall economy, from the macro side of things. So anyway, what do you guys think? Do you think we're going to have a 70 to 80% stock market crash? Do you think we're going to have any type of stock market crash this year? Do you think David's right? Do you think Harry's right? Look, let me know. And how are you investing? Let us know how you're investing and how you're preparing for the next couple of years or the next decade ahead. Love to see your thoughts and opinions in the comments below. If you like the video, please hit that like button. Really, really appreciate it. And if you haven't yet subscribed, do so. Hit that notification bell as well. Really appreciate it. Thanks, guys. Take care, and I'll see you again on another episode of Finance Uncut.